Hello, listeners. My name is Raj Singhal, and welcome to another episode of Breaking Investment Stereotypes. This episode is brought to you by Multipie.co, where we believe that investing is an ignored life skill. Our mission is to create a platform where people can come learn, share, and collaborate through the right tools. Ultimately, we want your hard earned money to work for you. Here at Breaking Investment Stereotypes, my job is to deconstruct world class investors or wealth managers and deep dive into their investing journey professionally, personally, or both, to get into how they've broken the stereotypes in a seemingly complex world of investing. I want to give little guidance on how to use these shows. None of the following should be taken as investment advice. Please see multipie.co/disclosures for more information. My guest for today is Lakshmi Iyer. Lakshmi is currently President and Chief Investment Officer Debt and Head Products for Kotak Mahindra Asset Management Company. She has been with the organization since the last 20 years. Joining Kotak in 1999 as a fund manager, Lakshmi was responsible for credit research, deal execution, managing fund performance across all debt funds, and assisting sales in client interaction. In addition to that, she has been a portfolio specialist and managed product-related initiatives such as product pricing and coordination with the fund management and sales team in that role. Prior to joining Kotak, Lakshmi worked with Credence Analytics as a research analyst where she was tracking corporate bond market in India and generating research reports. She was also instrumental in conceiving various financial software tools in collaboration with software and technical teams. Lakshmi holds an MBA degree in finance from Narsi Monji. She loves exploring new places for traveling and is a big food lover. Now, there are many firsts with today's episode. First of all, this is the first time we are featuring a fixed income specialist, an area where I spent most of my career. Secondly, this is our first episode with a female guest. Thirdly, she is a vegetarian like me. Lastly, she has Bollywood ambitions again like me. So this is going to be a fun episode with lots of Bollywood dialogues. Without further ado, please enjoy my conversation with Lakshmi Iyer. Hey Lakshmi, welcome to the show.
Thanks, Raj, and it's good to be talking about fixed income in a world which only understands and wants to talk about equities.
Yeah, that's true. Yeah, the fixed income is a big part, and we'll come to that part as well. But I think we should start with your life journey, including your career, because like me, you also belong to a rare one who have spent about more than 2 decades in an organization. So why don't you tell us about your career so far?
Sure. So I started off being part of the markets research, researching the bond markets with a company called Credence Analytics. I worked there for about 2 years. And then, as you say, luck by chance, for those who are Bollywood aficionados like I am, and Raj is luck by chance. I was also involved in a lot of analytics and technology in this firm, which is Credence Analytics. So I had to actually deploy technology solutions for treasury managers all across financial services. And that's how Kotak happened to be. So I joined Kotak Asset Management in November 99 as a research analyst again, researching the bond markets. Subsequently, I was given charge of the schemes that had to be managed. When I joined Kotak back in 99, the fixed income assets or the total assets for Kotak was just about 100, 200 crores. I don't even remember. It was some 3-digit number. As we speak, we are around 2.5 lakh crore. And that's been the journey for me in a nutshell. We are the 5th largest asset manager in the country today. And across this journey, I have played multiple roles. Even as we speak, I oversee the fixed income strategy for Kotak Asset Management, and I also oversee the product profile, which allows me to be in connect with both the business aspect and the market. And then because I get bogged down by monotony very soon, it just allows me to keep my energy quotient alive. So that's in a nutshell about who I am.
No, it's definitely not luck by chance, I must say. I mean, there is a lot of hard work which has gone behind, taking from 100 crores or whatever the 3-digit number were to 2.5 lakh crore is definitely incredible. And I'm sure a big part of as like the overall mutual fund itself, a big part has to be fixed income as well. So we'll come to the fixed income part now. The fixed income has always been a big part of everyone's portfolio, but most of the investments happen to be in fixed deposits with banks. So like banks would have about 150 lakh crores of deposit, whereas mutual fund total AUM is about 32 lakh crores. Of that, of course, fixed income is a big 45% of that at about 15 lakh crores. So, but still constitutes small part of overall India's financial market, right? So, this whole, and I really love this slogan by AMC called Mutual Fund Sahi Hai campaign. And I'm sure it has yielded, good results. But my guess is probably equities has been beneficiary of it through SIPs. What do your thoughts on the whole, why the fixed income mutual fund have not grown that much as it should have?
Couple of things. One is the general investor loves assured returns. So it's always fixed, and the query that comes always into the mind, as if mutual funds were to be a vehicle with mileage, the question is kitna deti hai? So unfortunately, debt mutual funds don't have answers to both these questions, because A, there is no assured return in any mutual fund investment, whether it's equity and specifically so fixed income as well. And second is that kitna deti hai answer, how much will I get? That is always a function of how the market forces actually behave. And I think it is a combination of these two factors which has led to a magnetic pull towards fixed deposits or any of the traditional mode of investments, where the rate of return or the interest that he or she were to get will be assured. So the word assured or guaranteed is probably the differentiating factor which has led to the AUM differential. Thanks to Mutual Fund Sahi Hai campaign, a good amount of financial literacy has percolated across the nation, and slowly but steadily we are seeing queries, and very, very intelligent queries from investors, even on the fixed income side. Slow but steady, we are getting towards it. Have we attained right the pinnacle? I would say, abhi picture baki hai. But we are beyond the trailer stage, I would say. So somewhere in that twilight zone is where we are right now in terms of spreading that awareness. And as more and more investors start realizing that traditional mode of investments are not really able to satiate their requirements for commensurate returns, there is, slow but steady movement towards fixed income mutual funds.
No, you're right. I mean, in terms of that, the stage at which mutual funds industry is probably still at the trailer stage. And I was just trying to look at the numbers in US. I mean, which is, where you can say is aspirational numbers. US total bank deposit is about 17 trillion. My sense is that their fixed income asset under management is probably around anywhere between 8 to 10 trillion. So that's still like about what 60-70% of their their overall banking deposit, where for us it's probably around 10%. So I think, and not looking at the absolute number, because absolute number doesn't make sense because of the state of the economy we are in, but at least in terms of the proportionate size, I mean, even including their ETFs have grown up to about 1.5 trillion now, which is fabulous. And we'll come to ETF part as well later on. Let's talk about since fixed income, including, I mean, the mutual funds is a big part of everybody's portfolio. How one should look at debt mutual funds from a portfolio perspective? And I'm not talking about the view on the market here, and we'll come to the view also later, but more from a big picture perspective, from asset allocation point of view.
So my view, Raj, always has been, there is a tagline for an ad which goes, "Har ek friend zaroori hota hai." So that way, I always believe, "Har ek asset class zaroori hota hai." So every asset class is equally important as part of your portfolio. If you look at the two broad asset classes, which is on the financial side, which is fixed income and equities, and I say this to many people, which I'm sharing with you, that fixed income is like lemon water or nimbu pani. It is a stability provider to your portfolio. Summer definitely calls for having nimbu pani. Even in winter, you can have it in room temperature. So it's an all seasons kind of consumption strategy. Whereas equity is like Red Bull or caffeine or energy boosters to your portfolio. You need to have the adequate mix of both these financial asset classes in your portfolio. The fallacy is quite a few investors assume that if they have sparing financial assets and they have overwhelming physical assets like gold and real estate, that is a short way to wealth creation. And that is where I have a difference of view, wherein it is the financial asset class like equities and fixed income, wherein equities is your wealth creator and your fixed income is your wealth stabilizer. It's a combination of these, and then you top it up. The icing on the cake is usually topped up. You never have the icing, you have the cake. So this is the cake, I would say, as part of your asset allocation. You top it up with some gold, with some real estate, and that's how your cake is baked for your future, for your retirement, for your goal planning. So in a very simplistic term, this is how you should treat asset allocation across various asset classes.
So can we go a little deeper into this? I mean, and I like your analogy of, Nimbu Pani and Red Bull, and you shouldn't have too much Red Bull anyway. But, I mean, equities tend to give a decently higher return over a period of time. But if somebody comes with, say somebody's just done fixed deposits always all their life, and they really want to come to the financial market and say, hey, Lakshmi, I have this pool of money, I have 1,000 rupees, or say 100,000 rupees or whatever, and then I want to allocate to. You tell me how to do it. Is there a way to think through that? I mean, you want to talk about that?
There is a way, definitely, but I always tell again, fixed or asset allocation seldom is DIY, do it yourself. It's more engaging with a financial advisor who he or she understands what your goal is, understands what the asset side of your balance sheet is, what the liability side of your balance sheet is. And after that, your advisor or your planner actually comes up with a holistic plan. It's easier said than done, where you Google for symptoms and try to self-treat. Even a doctor wouldn't like it. Why would a financial doctor like it? So while you have similar kind of construct, the ailment could be similar, but the treatment could be significantly different. I think similar analogy can be related to your own asset allocation plan, and therefore it has to be extremely mindful, targeted towards a particular cause. If you can link it to goal, nothing like it. And it could be very, very small milestones. It need not be everything is all 15 years and 20 years hence. It could be something as close as 1 year later, then 5 years later, then 10 years later. So accordingly, you create these small milestones and you plan accordingly. So if your immediate requirement basis, your goals are significantly higher capital outlay, then such a portfolio, it does make sense to be predominantly overweight fixed income. Even if you are a fixed deposit kind of a mindset investor and you absolutely have no requirement for money, maybe for the next decade or so, you're just keeping your surpluses right there. For such an investor who does not have any immediate capital outlay, equities could be the overweight. So as I said, there is no one size fits all. It requires thorough planning and absolutely meticulous execution.
No, you're right. I mean, there can never be one size fits all, because there are a lot of elements which comes into it. Investing is also about a lot about behavioral science as well, right? Your own risk appetite is super important. Very easier than you said that done. I mean, and we have seen the worst of the behavior and the best of the behavior comes when you should be doing opposite. Let's come to our favorite topic. And we had our. We used to do that all the time. What's your view currently? I mean, globally inflations are coming up. India has always been an inflation problem. RBI is keeping liquidity flush. In fact, actually adding more. And they've kept the rates historically low, right? I mean, the reverse repo at 3.35 and repo at 4. I mean, the overnight rates probably trading around 330 or so. I have never seen. I mean, these are lows in my own lifetime as well, and I'm sure for you as well. And RBI is trying hard to keep, yield control, not stated yield control, but through the acquisition program or whatever they call it. What do you think of the markets here? I mean, how should one look at the markets?
So right now, the world monetary authorities are actually reacting to more of a health scare or a pandemic, kind of situation which doesn't seem to be abating anytime soon, whether it's in India or whether it is world over. So that's point number one. Point number two is, therefore, there is even the Reserve Bank of India in our country who is doing the Main Hoon Na Shah Rukh Khan Act. And what this means is that the central banker is there to support the bond markets, whether it is for liquidity, whether it is for absorbing the excess supply, which is a resultant of fiscal deficit, all of that put together. The bond markets in India currently are, if I were to use an analogy, under the paracetamol effect. So why paracetamol? So if you are feeling feverish and if you have paracetamol for 6 to 7 hours, there is curbing of temperature and then it resurfaces unless your ailment is completely cured. Something similar is happening in the bond markets where, given the fact that right now inflation is not a material concern, the Reserve Bank of India is doing something known as GSAP, which is Secondary Market GSEC Acquisition Program. Now, this in global terms is nothing short of quantitative easing, where the central banker is actually coming in and trying to absorb the excess supply to ensure that yields remain range bound or there is orderly evolution of the yield curve. Our take is that given the combination of, I would say, troika of factors, comfortable liquidity, RBI's intervention when it's needed, and the fact that inflation is not looking so ominous right now. I think it's a combination of the three factors where we believe that the rates in India will remain range bound. It will not go materially on the higher side or significantly on the lower side. There is a case, given the current situation in India and the uncertainty which still exists on the pandemic front, to probably be on an extended pause as far as the monetary policy or the rates or the benchmark rates in India are concerned. Probably the normalization process, which is the liquidity normalization process, which started off sometime in January of this year, through VRR or variable reverse repo rate, I think that would continue because RBI has been mindful of normalization, yet trying to be safe than sorry in such a market scenario. So I think that's the way forward. So I think the theme for fixed income investors in 2021, in my mind, is on the carry. So the carry YTM portfolios over potential capital gains could be a more overwhelming or overbearing trade at this juncture.
So I'm loving your analogies, and I'll bring the analogy of Ajit jokes as well. As we used to speak all the time that this is called a liquid oxygen, where liquid तुम्हें जिंदा नहीं रहने देगा और oxygen तुम्हें मरने नहीं देगा. So probably RBI is buying bonds, and the expectation of inflation probably acting in the two opposite direction. I'll talk to you about the expectations on RBI rate hike as well. And if you look at the market, and especially from the interest rate swap side, the market is pricing in that the overnight rate will move up to probably around from 3.30 to say 4% by December, and then probably to about 4.5% to 5% in next 2 years, and then a terminal rate of 6%. You guys have any thoughts on expected rate hike from RBI?
Markets are clearly running way ahead of what the RBI probably intends to do. And I recall in one of the statements, I don't know if it was the RBI minutes or elsewhere, in one of the annual surveys, RBI did mention that it takes two to tango and forestall a market tandav. So clearly the markets are in tandav mode. And if you look at the yield curve today, it's one of the steepest ever that we have seen.
Yeah, it is. Yeah.
High grade corporate bond around 4%, and a 10-year corporate bond high grade at 250 to 275 basis above the 1 year itself is telling you that excessive paranoia has already crept into the markets. And therefore, as I said, even if interest rates were to go up, say by the end of this year, does it provide reasonable cushion for investors at the mid to long end of the yield curve? The answer is yes, because ultimately the day-on-day run rate, as we call the run rate in cricket, the run rate on higher yielding portfolios without diluting the asset quality, if I were to say, I think is more overpowering than running a very, very low duration portfolio and trying to compromise on the carry. So I think it makes sense to actually create a low to moderate duration portfolio in fixed income at the current juncture, because liquidity is not going to abate itself anytime soon. It might reduce, but is it going to become deficit? I would say the answer is no. I think there is a combination trade which is clearly possible in the markets today. If you are reducing duration in the bond markets today, you are just buying peace of mind. It need not necessarily translate into a potentially superior returns.
Yeah. So I think it's a good time we move from we've been mostly talking about RBI and government securities, which is a risk-free paper from the credit point of view, and let's move to this whole in the fixed income space. There are two elements, right? One is the duration, and then the other is credit. And you mentioned part of that in while telling us about your view. How does one look at this whole play between, or it's not a one versus other, but again, these two things about duration versus credit? How should one look at that?
So these are two parts of the same coin. In a marketplace, there are typically three types of risk on the fixed income side. A, the duration or the interest rate risk. B is the credit risk, and the three is the liquidity risk. When you are investing via fixed income mutual funds, the open-ended ones, typically the element of liquidity risk is not really there, but you are still grappling with a duration risk and of course the credit risk. The fundamental difference between the two is that in case of duration risk, or when you are investing in high grade sovereign, like gilt funds, for example, your capital is never lost. So while there are mark to market losses, etc., because the portfolio yield increases, it just kind of buffers in and you recoup your losses. So it delays your return, gratification. It does not derail it. So I think that is fundamentally different when you actually look at a credit loss. When there is a credit crisis or a credit default in the market, if I have a portfolio of 100 rupees, of which one rupee has actually defaulted, that is a permanent loss, and the entire return actually gets shafted off. But as I said, because of the benefits of diversification, whether when you're doing through a mutual fund, again, that 1 rupee does not really impinge substantively on your portfolio. Are both these risks desirable for the investor? Well, I think it's a function of risk appetite. Even a diabetic, for example, can afford to eat one rasgulla. It doesn't hurt him or her. But if you infuse too much of sugar syrup into rasgullas and you consume that for breakfast, lunch, and dinner, definitely, even if you don't have a sugar issue, you end up having one. So I think in right proportions, if you have some investors, unfortunately, because he or she got carried away with the potential high yields of such portfolios, assume that you can have, it's okay to have rasgullas for breakfast, lunch, and dinner. So I think if you do not get excessively swayed between greed and fear, there is a legitimate way that you can use both duration and credit funds to your advantage.
Yeah, so let's bring in this rasgulla in a double dip syrup and bring in the episode of Templeton here, because that's been credit as a portfolio or as a asset class did very well till we saw what happened in this Templeton episode, and probably there was too much sugar syrup into it, and it really had a big dent into the product. Now, whether it was a clear case of asset liability mismatch, maybe there was some bit of a wrong selling as well. I guess you guys did very well in that whole episode. Do you want to spend a few minutes on talking about this whole credit portfolio and impact of the Templeton thing and how one can avoid that?
Sure. So the episode which we are talking about, which happened in April 2020 with FT, was more of the underlying liquidity issue associated with those fixed income instruments at a time when the pandemic had set into the country and we were in the midst of a lockdown. The asset liability mismatch in mutual funds is pretty live even as we speak, because most of the open-ended funds offer daily liquidity. So you can come in today, you can exit tomorrow by paying an exit load in some funds, without paying an exit load in most funds, because the underlying decides whether or not there should be an exit load. So it was more of a liquidity issue which impacted one fund house and few schemes. Unfortunately, the entire canvas got painted with the same brush for the industry, and investors actually rushed to make a beeline exit out of all credit funds in the industry, saying that in this one basket, we are not going to really make a differentiation between different breeds or different grades of credit underlying. Unfortunately, and this is something which we keep saying, it's not that with the benefit of hindsight we are saying right now. We said this even at that time, that panic causes only pain, no one really seems to gain. And I live by that, because if investors had lived with most of these credit-oriented funds, or those funds which had non-AAAs in the portfolios, and use that as opportunities to allocate more depending on the risk appetite. See, these funds are not clearly meant for those with absolutely weak hearts and who have to consume pills every day to actually look at their portfolios. It's not really meant for them. So if you are that risk taking category, those were the times where spreads between AAA and non-AAA had shot up to 4, 5, 6%. The yields were all over the place. High grade AA assets, high grade AA plus assets were available anywhere in the band of 11 to 13% in INR. And today, most of them are available in the band of maybe 5.5%, 6.5%, or 7%. Have interest rates come down in the country by 6 to 7% in the last 12 months? Obviously, the answer is no. The interest rates have remained broadly flat. So those investors who actually did not succumb to fear at that point in time and actually rationally allocated investments subject to their risk appetite have actually borne the fruits of it. So clearly, as I said, there is space for these kind of strategies to flourish. One needs to be mindful that if you are driving on the road, accidents are bound to be there. Can you equip your vehicle with high-end airbags and make sure that the uptake or the wear and tear of your vehicle is in good order? You probably might still escape with a scratch. But to say that when I am driving on the road, I will not encounter anything, if you are coming with that mindset, then you're better off keeping your vehicle in the garage. So I think investors need to rise to the occasion and understand that one episode may not render the entire category vulnerable.
Okay, yeah, thanks. Let's add a good segue to bring in the angle of risk here, because no investments can be looked at without taking into account the risk element. And frankly, we all have observed that people usually chase returns, right? So risk hai to ishq hai, and I'm getting inspired by your analogies here. But then everybody has to be ready with heartbreaks, like in a ishq. So how do you guys look at risk? How do you look at the risk management at your house itself? And B, how do you make sure the clients are made aware of the various risks which they're running in the portfolios?
We look at it slightly differently, Raj. We always believe that it is if you have to choose between return on capital versus return off capital, for us, the choice is always the latter. And therefore, it's always risk-adjusted return, which is an overpowering theme when we actually construct our portfolios. Risk is the most forgotten four-letter word in good times. And we always don't live in good times. So I think it's extremely important as money managers, we have to be mindful of the risk, despite the fact that as humans, we also, it's quite natural for us to get carried away in pursuit of chasing that higher returns. But we all know that in the mythology Ramayana, when Sita actually crossed the Lakshman Rekha, that was the root cause of the entire Ramayana episode. So one needs to be absolutely mindful that you need to have contours for your own portfolio management, for your own portfolio construction. And come what may, these Lakshman Rekhas, which are imposed either by the regulator or by your own internal risk, you need to ensure as money managers that you should not cross it. It's very difficult. There is a very thin line of differentiation between conviction and foolhardiness. But when in doubt, it's always better to play safe. I think that is probably one of the reasons which has helped us at Kotak as an organization to probably steer clear. It's not, as I said, always about returns. And I go back to my Rasgulla example. The more underlying is populated with this, the tendency of the returns flourishing could therefore be higher. But the health hazards that it can have on your financial portfolio cannot be completely ignored. So I think there is a tightrope walk as a money manager that is required. And I'm happy to share with you that, yeah, so far so good. That's exactly how we approach fixed income management. And this is something that we talk to our investors day in, day out, saying that रिस्क है तो इश्क है, वो ठीक बात है, लेकिन सिर्फ इश्क से पैसा नहीं बनता है. So you have to be mindful that the balance is created.
To complete your view on the market, and you mentioned that you like carry kind of trades with basically lower duration. In terms of the credit, any particular bucket of the credit you would like more?
No, in the credit space, so I will break it up as far as the government bonds and say the corporate bonds. In the government bond space, we like the 5, 6, 7-year segment. It's not too high, it's not too low. It's right there, as I said, in that twilight zone where it satiates your appetite of having high grade. It satiates your appetite of having a reasonably good carry. And there is a good gap between, as I said, 1-year instruments and these instruments. In the non-government space, while we like AAA assets, there is a reasonably good case to own high-grade non-AAA credits, which are frontline businesses. It's going to be absolutely a cherry-picking game. You can't just take a sector view just because you are bullish on a sector. You pick up whichever stocks you get in that. That's not the way we would approach the credit space, especially the non-AAA segment. In that, we like the 2 to 3 year segment, which is, I would say, a relatively sweet spot. It takes care of the issuer's aspiration of not being, wanting to raise too short-term money. At the same time, we are mindful that, interest rate cycles or business cycles change maybe every 2 to 4 years. So you are at that spot where right now things are gradually resolving for itself. Risk still remains, so it's not that risk is completely out of the burner. So we are mindful of that. So therefore, in GSEC, we are happy to go a little bit long, but in the credit, especially in the non-AAA space, we're happy to be slightly low to moderate.
Okay, thanks a lot. So let's move into another topic about the product innovation and especially related to fixed income mutual funds. I remember there was a big innovation when fixed maturity plans were launched, some time back. I'm not so sure, how much innovation probably has happened after that. But I want to talk to you about 2 products here. One is the, global access. So equities have done a decent job. I mean, not a decent job. It's still not a big market, but at least there are feeder funds where Indian investors have access, US equities or even China equities through the feeder fund. So that is something which is there. But at least I'm not aware of any such thing on the fixed income, though, there are always some great opportunities which comes in fixed income space as well. And look at, right, I mean, when the March crisis was happening, everything was going cheap, but especially some of the fixed income dollar credit. And for example, like even say Muthoot and all, they were trading at 60 cents to a dollar. I mean, and so the yields are 60, 65 cents to a dollar. And same went for say Tata Steel or Tata Motors at the time. So that is one I want to talk about. You have are you seeing that? Is anybody trying that, or why nobody's trying that then?
So when you are diversifying out of a geography, it's largely been equities, because that is where there is the delta of wealth creation, because bulk of the fixed income ranges are all very, very low ranges. The yield differentials are not very substantive. The key reason why investors choose to diversify, A, is you are offering a very different asset class. Second is as a potential hedge to the currency, which is the INR. So if bulk of your assets are rupee denominated, it helps, if you have, especially in a trajectory where the rupee has been depreciating, it does help if you have some assets outside the country. So these are the two cases, or these are the two key reasons why investors in India choose to diversify. And in that, I would say fixed income would come lower compared to equities, as I said, because in a environment where there is usually risk-on environment where investors are encouraged to take more risk, equities become pretty synonymous with risk. And in that, there are certain geographies outside India, outside Asia. There are some themes, for example, like the current phase you're seeing. Technology, innovation as a theme, etc., which is doing exceedingly well. Now, all of that, can be satiated only or largely with equities as an asset class. And therefore, when it comes to innovation, that sort of an innovation in fixed income is predominantly restricted to newer types of strategies within the India space. So you can do passive, you can do open-ended roll-down structures. You can do hybrid portfolios, which is a mix of fixed income and equity. So, these are some of the innovations which can bring about innovation for the sake of doing something on the fixed income side, especially when you have to be mindful. Returns outside of India are very, very meager. Still as we speak, some parts of the world are in negative rates. And of course, the intensity is reduced. But when India as a country offers one of the highest nominal rates and real rates, I see very, very limited reason for such investors to diversify outside geographically, at least on the fixed income side.
Okay, thanks. Second thing I've always been very intrigued is that why there is not a large, actively managed with a very flexible mandate kind of a fund. I mean, right now, the way mutual funds are generally being sold and probably by distributor are that, I mean, I've seen, when we have seen that for many years, right? They usually based on where the 10-year bond is, and if 10-year bond is yields are very high, people will say, okay, now go in duration or reduce your duration or typically like that. But we have never, this whole active management, rather than telling customer to do the management on their side. I mean, why not a fund like that, which is actively run by a fund manager, and which can take into account all kind of situations, whether it is high duration, low duration, or credit curve, or going up, down the credit curve. Is there something? I mean, or there is no customer appetite for such a product?
There are such strategies which are available in the Indian fixed income space via mutual funds, which is basically they call dynamic funds or flexi funds, as some of them call it. But unfortunately, what happens is in an interest rate environment, which typically tends to rise, for example, and that's the general perception right now that maybe with a lag, given what's happening on the inflation front, etc., interest rates could actually go up. There are very few takers for such strategies, and it's more of I call it a placebo effect. It's more that feel good factor. Oh, I'm at the very short end of the yield curve, so I'm absolutely fine. Unfortunately, dynamic strategies, much to their lack of knowledge or ignorance, have done exceedingly well. Most of them, rather, have done exceedingly well across interest rate cycles. But the perception that because it's dynamic, it can run a higher duration, and I am trying to take too much of a view on the portfolio manager, which I'd rather not like to take because of the sharp volatilities. Another thing which, Raj, we need to keep in mind is that investors can lose capital left, right, and center in equities, but they are absolutely not okay to take even a day or two of volatility in fixed income. So, all of these act as very, very strong headwinds for meaningful allocations to the dynamic bond funds. But yes, is there a strategy in the industry? Definitely, yes. We ourselves have been running a fairly successful, dynamic bond fund. But yeah, the AUMs are nothing great to talk home about.
No, that's a sad part, actually. I mean, but you're right that investors' appetite to take any kind of losses in fixed income has been dismally low. Yeah. So we have spoken enough about the market. Let's move to your stuff, how do you, so let's talk about your own personal finance, right? How do you manage your own investment?
So I'm a very old-fashioned and very boring investor. I believe in fill it, shut it, and forget it. Bulk of my investments are actually via SIP or systematic investment plan. Because if I earn a monthly income, it's only fair that I do my investments on a periodic and a monthly basis. And the fact is, if you have, and if you're doing this consistently, you don't really have, or you don't really have the itch to time the market. So I think that's worked well for me. I might not be a churner's delight because I really don't touch my portfolios for a very, very long time. Some small course corrections on asset allocation, etc. If required, I end up doing it. I have about 5 to 6% allocation to gold, which is through ETFs. Otherwise, the portfolio is predominantly oriented towards equities because I don't have any huge requirement of monies for very, very short term. So it's pretty goal linked, with particular intents, like for example, a reasonable good corpus that was required for my son's education. Whether he does it or no is secondary, but it was important for me to plan it well in advance so that 2 years down the line, when I actually when the day actually comes in, I'm not left in the lurch saying that, I should have planned this better. So for me, goal planning has clearly worked. If that goal is not reached, or if that goal gets prolonged, then obviously I might have to tweak my asset allocation, probably move that good chunk into fixed income. But as I said, this planning is definitely required. And I would urge every listener to actually spend some time initially, because after that, it goes into autopilot mode.
Okay, I mean that's a great way to look at it, and glad to know that you have more allocation to the equities, because I'm sure your portfolio would have done exceedingly well as compared to any, and that to passively manage. I don't think active management does any good to people. So let's come
all my
to
SIPs, Raj, by the way, all my SIPs are in actively managed diversified equities, because if you have a combination of large cap and mid caps in your portfolios, or if you have skewed towards mid caps, it has been demonstrated over the past maybe 10, 15 odd years plus that active management has added or has aided in generating alpha. Ultimately, we crave for that small bit extra, but you have to time to your investments. I think that's exceedingly important.
No, I was talking about the actively management on your part, not of course, actively managed fund, but not yourself actively doing that. I was you have a very popular Twitter handle as well, and I've been following you, and you post almost every day, probably a pick of the day, and I really like them. So how do you choose them?
I read a lot. My day usually starts with markets, tracking what's happening. We have an offshore team in Singapore, so we're tracking even the Japanese markets across the world. By evening, I'm tracking the US markets. And then when there is that me time for me to read stuff, I end up reading something. And I believe that a picture can speak 1,000 words, what probably none of us can communicate while typing those messages. So therefore, with that, I just put a one-liner or just leading question, and anything which I like in a particular article or in a particular thing, that picture is what encapsulates my thoughts and views. And I've realized that that in a world where the attention span has significantly reduced because of the fatigue which has set in because of the digital world that we're all exposed to for the past 12 to 15 months. That clearly works wonders. So my nighttime, after dinner, a couple of hours before I sleep, is purely dedicated to reading, and that's how I get my picks of the day.
Yeah, and I will ask every listeners to follow Lakshmi, and I will put her Twitter handle on the show notes, so you'll know where to see that. What books? So you mentioned about books. What you mentioned about reading. So, what are you reading? Any books, and which books you like?
I try to read largely non-finance books. I don't really read too much of financial books. I read a lot of articles. I follow a lot of blogs. Those are the stuff which take care of whatever aspiration I have on the keeping myself abreast. I read a lot of sell-side reports that come in, on the globe, on the economy, on the asset classes, various asset classes. It could be even cryptocurrencies, for example. So all of that, I read through these articles and these blogs on a daily basis. I largely have a fetish for non-finance books, because I'm part of a book club where none of them actually belong to the world of finance. So it just makes it so beautiful for me to break away from the clutter and try to read at least one book a month, which kind of gives me a different tangent in terms of thinking. Otherwise, as I said, I started off by saying that I get very easily bogged down by monotony, and this is the last thing that you would want in a virtual world.
So which is your favorite book? You mentioned about book club. So anything you want to mention? Any books?
No, lovely books, but this last 2-3 months back, I read this book called Where the Crawdads Sing. It's a fantastic book. I don't want to reveal too much about it, but it's all about this girl who is, kind of left in the lurch. She's brought up without, her mother, and, even her siblings desert her, and how without any formal education, she does stuff on her own, and life skills, etc. she picks up. It's a fantastic book. So, you can draw a lot of parallels by reading such books. I've also read in another session of our book club, there's this book by Sanjeev Sanyal, which is Life Over 2 Years, and many more. These are all short stories. Again, a very racy read, very interesting. Nothing related to finance. One would think that, because it's Sanjeev Sanyal, he was written all about finance. So it's not about that. So, these are some of the genres. Again, it's not any specific author that I like. It's just that somebody recommends a book in that club, and we all end up, reading that book. So it's just that it just makes for a very interesting conversation. And as I said, I am so happy and blessed that none of them actually even understand the word. They can just spell the word finance. So that makes it a very affable community for me to relate to, because you really need to break in the clutter.
Okay, I've not read any of those 2 books, so I'll definitely look forward to reading them. Let's come to our favorite topic, Bollywood. And you mentioned you have Bollywood buff, and so what's your favorite Bollywood movie, and what are you doing with your Bollywood aspirations?
Nothing. I don't know. Bollywood is just my way of venting out a long day's work. So usually it used to be first day, last show. So, if you know, Raj, in India, every Friday, literally every Friday, there used to be a Bollywood movie release. And I used to see the first day, last show, which is usually the 10:30 show, because Saturday would be pretty easy going. There are meetings also. It's usually in the midday kind of thing. It's not like really early in the morning. Markets are shut. So all these movies, I use, a lot of course, it's not scripted because I have to recall some of them, but a lot of parallels can actually be drawn to the world of finance. A lot of parallels when I do my roadshows, when I used to travel in those happier days, when I used to travel across the country, world, of course, outside India, nobody understands much of Bollywood. So it made, talking and these presentations that much more lively. Asset allocation, fixed income is, perceived very scary, perceived very boring, perceived very dry. So, when you take some of these examples, it just kind of relates. So when I tell people that GSAP is similar to Mehuna, it just kind of strikes a chord, because in that movie, Shah Rukh was available, as the so-called guardian angel for his people. So I think those are the kind of analogies I try to quote to the extent possible to make fixed income less scary and therefore more approachable. Not too many releases have happened, but I think some movies which have left a lasting impression, just like that, where I wouldn't mind watching them over and over again, is this movie Chichore. I don't know if you watched it.
Yeah, it's very nice. Yeah.
Yeah, then Dil Chahta Hai is evergreen. I mean, I can watch it so many times and I'm not get bored. Three Idiots, again, very lasting impression. If I want some fun quotient, I actually go back and see some old movies like Golmaal, Amol Palekar. These are those Khubsurat. These are some of those evergreen movies. Sholay, again, another very different genre. So some of these movies, again, I don't have any particular liking for just one cast or other, but they just energize you and they just make days and nights much more easier. So I think that's the Bollywood quotient in me, which I still kept it. Now, of course, OTTs have taken over, so whatever movie quotient has to be fulfilled. It's largely through movies are less now these days. The shows are more. You have series, but I still try to watch some movies to the extent possible.
Yeah. So whenever next time RBI shows their might to the market, one more movie I can talk about is Tiger Zinda Hai. I think that should be also appropriate for RBI Tiger Zinda Hai. Who's your life ideal and investing ideal, if you have any?
Many, Raj, I don't follow a particular style, to be very honest. My initial life lessons, whether it's knowingly or unknowingly, I would say largely unknowing, was actually taught by my mother, where she instilled the leverage concept, that leverage should not be so significantly high. And she kept talking about the fact that why you should spend only within your means. And today, the root cause of all credit crisis, bulk of them, is been because of excessive leverage or mindless leverage. So I think those were the initial days. And then, of course, as I said, I do read about a lot, many portfolio managers, how things, and you pick up the best of both worlds. You learn from some people how to do things. You learn from some people how not to do things, So when a hedge fund goes belly up, you actually realize that, it is that conviction or the foolhardiness line which was breached, which probably led to something like that. Or, probably things just go swiftly out of your control. So I think I just try to patch up multiple, investment houses, their views, their philosophies, and that's what makes things slightly more holistic rather than sticking to a particular style. Usually, there's a classic debate in equities, value or growth, and people have equally high value followers as much as they have growth investment gurus. Fortunately, in fixed income, there is none like that. So, you can, choose your turf and you can, expand the horizons as much as you can.
Okay. So this is our last question, and I ask every guest about this, and not to talk about age or so, but what will you tell your 20-year-old self? If you're 20-year-old, what will you tell yourself what to do?
If I am 20-year-old, or maybe he is.
Yeah, what will you tell your own 20-year-old self? So, what you would have known at that time, which would have been useful to you?
No, I always say two things, and I tell this to myself even right now: start early. I did the mistake. I did not start my investments early. So, and when somebody asks me, how soon do you want to start? I tell them, start as of yesterday. And the second most, that's on the investment side. And the second most important thing is that don't spend your time in excessive planning, because when you're planning so many things, life always has another plan. So live life king size, enjoy your day, live your moment. Don't excessively worry about tomorrow. Don't ruminate about yesterday, because you don't have control on both. What you have control is on the present, so just enjoy it. I mean, I have fully lived that to the moment. If I could undo, as I said, something, if I were 20, probably I would have, would I have started my investment? The answer is yes. I could. I probably started a few years late, but those few years are sufficient enough, as I said, to let compounding work against you. Start early and enjoy life to the fullest. Don't excessive plan. It never works.
I think those are golden words, and frankly, we also believe that investing is a life skill, and actually nobody teaches you that skill, right? I mean, it's so important to teach everybody, and that's what I've started doing now. And I'm part of our business as well, but I've started educating my own family members, and I have a lot of them who are very young, and I made a group, and I keep telling them what to do and not to do in terms of how to learn about these things. So I think these are great words, and with that we'll come to our close of our podcast. Thank you so much, Lakshmi. It was really nice talking to you, and hope to meet you soon.
Awesome, Raj. Thank you so much, and stay safe and stay invested.
Yep. Thank you so much.